All righty. Welcome to today's webinar. I'm Cassie Pallison, DocSend's Director of Comms and Content. As some of you may know, DocSend is passionate about putting actionable fundraising insights and data in the hands of founders in hopes to improve founders' likelihood to successfully raise. This umbrella of research we produce is called the DocSend Startup Index. If you're interested in staying up to date on our research, you can subscribe to our weekly newsletter at docsend.com/newsletter. Today, we're excited to dive into our latest findings on pre-seed fundraising. Some logistics: this webinar will be recorded and sent to you within 24 hours, and we will save Q&A till the end. I'm excited to be joined by Russ, DocSend's co-founder and CEO. As a second-time founder and angel investor, Russ has deep fundraising expertise to share from both sides of the table. Let's jump into it. Take it away, Russ.
Awesome. Thank you, Cassie. I'm excited to be here. I'm excited to go over this stuff. This is one of the favorite parts of my job, that we get to do this research because, I have a deep connection to it personally, having been through the fundraising process many times. And just thinking back to when I got started with my first company, Pursuit, and how little I knew about fundraising, and fast forward. And so, I always got a lot of anecdotal advice back then. And then this is just really fun to have a larger and what is real. And a lot of the research or advice I got when I started my first company was from the point of view of venture capitalists, which is not really the same thing as getting it from another founder. It's like the panel of older, successful VCs that are basically saying what you need to do to pitch them. But what you're trying to figure out is, can I raise? How do I raise? What do I need to do to set myself up to raise successfully? And that's what we're focused on here. A little bit about DocSend generally. It's a nice way of sending links instead of attachments, and you get to see who reads each page and how long they spend on each page, and if they forward it to the people they said they're going to forward it to, or if they forward to the people they said they weren't going to forward it to. And it keeps everything up to date because your deck is often changing a lot, and so you can make sure that investors always see the latest version, as opposed to saying, oh, just kidding, don't look at that other PDF I sent, here's the latest version. So anyway, that is what DocSend does. And as a company, we've got almost 18,000 customers now. It spans a lot of use cases. It's a horizontal technology that we market vertically. So we get used in sales engagement, we get used in customer success, we get used in M&A, we get used in investor relations, board decks, all sorts of different things. So down the road, keep us in mind for other use cases if you're using us for your fundraising pitch deck. We also have a full dataroom product and an esignature product that's just baked into DocSend. So it is very flexible. And fundraising is a minority of our revenue, and we have programs to give it away at a discounted rate through incubators and VCs. But we do this research because I care about it and it's fun. And in terms of our methodology, everyone that is in this data set here is opt-in and aggregate and anonymous. So in the future, if you ever get an email from DocSend being like, hey, participate in our research, please say yes. It's really useful, and you're really paying it forward to the next generation of entrepreneurs who are just getting started and can really benefit from knowing, what is going on in the market and how it works. And this is changing and it is dynamic, and you'll see that 2020 was super different than 2019, and who knows how 2021 will turn out. But we need to constantly be doing this. So please opt in if you ever get an email. And also, we never look at anything in your DocSend account. Remember, banks, financial institutions are using us. We're incredibly secure, privacy oriented. But when you sign up, we ask you, what are you going to use us for? And if you say fundraising, that's how it triggers sending you that email later to say, would you participate in the research? So that's how we know about that. Understandably, some people are like, how do you know? And it's all very above board. And there's a link in there to the methodology if you want to dig in more detail. So we're going to talk about the makeup of your pitch deck. There are three sections that we're going to go through today. And the first is just what is in a deck. So if you're going to raise a pre-seed round, you need a deck. Typically, unless you're a multi-time founder, and that deck, really the purpose is to get you a meeting. It's to share enough information with the investor that they can say, I don't have a competitive investment, and this is interesting enough that I want to meet with you. So that's what your pitch deck does. And you'll typically send that through other founders, or you can kind of get it into the VC hands however you can. And then the question a lot of people have is okay, what do I put in that thing? What are in the decks of other successful founders? And a lot of people will publish theirs and you can see it anecdotally, but we want to dig into like a larger number and say like with more certainty, like in aggregate, like what is in there. And we also have failure decks. So if you fail to fundraise, please opt into the research as well, because that allows us to compare and contrast like what works, what doesn't, and again, help all of us founders be smarter. Okay, so the first thing we're going to look at is the amount of time that investors spend on your deck. And one quick takeaway from all of this is that, you know, in 2020, for, you know, successful decks, it was a little over 4 minutes. You might say that's not that much time. You might say it's a lot of time. I think it's a lot of time. They are downloading a lot of information in 4 minutes. And that's why this system exists, because a VC can go through thousands of decks only spending 4 minutes each, versus every 30-minute meeting is so expensive for them time-wise. Couple of things to note here and how the market is changing. In 2019, when we looked at successful versus failure decks, they were about the same in terms of time spent. Last year, big difference. Success decks at 410 and unsuccessful decks at 136. And what we're actually seeing are a lot of 20 and 30-second views where the investor just bounces out. So you got to remember and have some empathy for these investors. They are not going to conferences. They're not getting on planes. They're just sitting at home. This is not a financial crisis, though. So everyone's got plenty of money to invest. SaaS companies in the public market have never been doing that this well. And every IPO that happens, that money gets recycled back into this whole like ecosystem of fundraising and startups. So investors are very, very active, but they're also increasingly impatient, and they're saying no faster. They're being more efficient with their time. And the takeaway as a founder is that if slide 8 is your best slide, they might not get there. So, you know, just remember, like if there's like a rough bumpy part at the beginning, people might just bounce and not keep going through your deck. So your narrative has to be super buttoned down, and your deck needs to flow really, really well. And a lot of times founders will ask like, oh, I just don't get feedback, or they say it's not a fit. And investors just won't share with you why they're bouncing. It's not in their best interest. They don't get anything out of it. And frankly, they look at too many decks to be able to give personalized feedback on each of them. But what you'll see in your view time is they're just bouncing, you know, and then you can see in DocSend in aggregate, like where the drop off points are, where people are spending time. So if people are all dropping off at a certain point in your deck, that's good to know. Go back and like have a feedback session with another founder or a previous investor or your parents and be like, does this make sense? And see if there's a point where people are like, no, you kind of lost me there, because that'll kill it. That'll kill your whole fundraise right there. Like you might think everything is awesome, but you just don't get the meetings and you can be dead in the water, even if you have an amazing company and you deserve to be funded. So keep this in mind. And you know, this is all about first impressions. So when we look at you know, first visits versus like subsequent visits, you know, your successful decks will have a little bit less time spent on subsequent visits. Like they open it first, they like read through the whole thing. They're going to go back for confirmatory information later, to see like, oh, what was their approach to the market or marketing or competition or team or something like that. So people will have repeat visits to it. But again, really stark difference between the first visit for successful and the first visit for unsuccessful. And for unsuccessful decks, you will still get subsequent visits, but they're still shorter and people are just kind of confused about something in all likelihood. So there have been a few big shifts in 2020 that we expect to carry forward in 2021 versus 2019 and before. Because remember, DocSend, we've been around, we kind of were generally available starting at the beginning of 2015. And so we've got years of data on this to compare against. And what's happened has been in the last 6 years, pre-seed has become more defined as a round. There have been an increasing number of firms that are focused just on pre-seed, like Charles Hudson at Precursor. And so it's becoming more standardized, and therefore the metrics and what people are looking for are becoming more standardized as well. If you go back like 7, 8 years, the pre-seed was really just friends and family, and most of them didn't have a lead investor. And that means the criteria was kind of all over the map. But now that you have more professional investors leading pre-seed rounds, they're bringing a level of professionalism to it that wasn't there. This is, by the way, a good thing by and large, because it means that there is more money for pre-seed. And as a founder, it is always better, in my opinion, to raise from a firm, because they can give you a term sheet And that just expedites the rest of it. Angels are happy to join when you've got a term sheet, some professional investor bothered to like do the diligence on you and said thumbs up. Like that makes it super easy to fill out that round. And your job as a founder is to get back to building your company. You don't really get extra credit for the time you spend fundraising. So these 3 metrics: 1, competitive landscape. Again, remember, we're in a time where there's a record number of companies getting started and getting funded, which is awesome. And I think there's so much left to build in the world of software. We're just kind of scratching the surface. However, that does mean that investors want you to have an understanding of your market. It's not to say that you have to have like no competitors. It's just to say that you understand the market that you're working in and are knowledgeable on and can talk to why you have a chance of winning. So don't shy away from competition. People are spending more time reading that, and you've got to have a thoughtful answer. The next one is product readiness, and we'll get into this more later too. But pre-seed is all about the product. It used to be the case that you could do a friends and family or pre-seed kind of minimum viable PowerPoint. It's not really the case anymore. It's not to say that you have to have a publicly launched, generally available, fully developed product, but it is to say that investors are judging you on your ability to build the product. So if you're at the pre-seed and you're like, oh, I'm a business person and I'm looking for my technical co-founder, but I have a PowerPoint that kind of talks about what it is, that's not a great place to be in because you just don't have anything built yet. And people do scrutinize those product slides. And product slides are like in DocSend, if you put an animated GIF into a PowerPoint and then put that in DocSend, that'll actually play. So you can actually kind of bring your product to life and show some movement in it. Or sometimes people will hyperlink to videos, or they'll have screenshots in there talking about their product. And the last is business model. And this is one I kind of get into arguments with founders about sometimes, where a founder will be like, oh, this is a huge market opportunity. This is great, everything's great. And then I'm like, oh, okay, well, how are you going to monetize? Like, wow, we've got 5 potential ways to monetize. And it's like, okay, that's confusing. Can you just pick one? Like, which is the most likely? And investors in general don't like seeing like open-ended, like, I don't really know, I haven't thought about it yet answers. And so pick a business model, and it is being scrutinized more than it used to be. You know, how are you going to make money someday? How likely is that? And how risky is that? You know, and in software, like, it doesn't have to be a complicated answer, and your business model ideally is not a complicated answer. It's like DocSend is a SaaS product. We charge a monthly or annual fee to use our software. That's it. And it's product led, it's 100% inbound, it spreads virally. That was hard to pitch at the seed for us, but later on just became empirically true. And so, but again, stick to your guns around it, and have a clear answer to business model. So this one is really interesting, and this has changed not just in the last year, but in the last like 5 years. And I think the pandemic accelerated this trend, which was already happening. So we've got this increase in the number of people who can write code. The number of software developers out there has changed a lot in the last decade. Like when I graduated from Stanford in 2006, like CS was a very tiny major there. Everyone was like, everything's going to be outsourced, and it just hasn't happened. Now CS is the largest major at Stanford. It's actually half women, half men. So you're getting an increasing number of people that can write code, and writing code is also something that's just generally useful in life. Not to say you have to go be a software engineer with that. Anyway, the skill set, more people with that skill set, cost of writing code's coming down, the productivity of your average engineer is going up. And so for pre-seed, a relatively small amount of money in the kind of your earliest round, people are expecting you to have something to show for it. And so, no product is only 11%. So if you're saying like, minimum viable PowerPoint, that's all I need, that could be true. However, only 11% of successful companies in our data set had no product at all. Most fall, so 70% are alpha or beta, and 19% are like general availability at launch. What's interesting here is that a lot of founders are choosing to, and this comes back to traction, they're choosing to say, it's not generally available, it's not totally done yet. Here are, customer quotes, here are engagement numbers. And by the way, we're going to raise this pre-seed round to build the product to general availability, general launch. So it's kind of like the mystery box of what can happen. If you're post-launch raising your pre-seed and you've got like a flat line, or it's like, everyone's going to be like, well, you've launched it and it's not doing that well. So, but again, 19% have generally launched it. But this probably comes back to traction. It's worth noting that for the seed, you kind of have to have a generally launched product. But for the pre-seed, you can get by with something partially built, but you just have to have something built generally. 70% of successful founders. So Often at pre-seed, you don't have a burn rate and a cash out date because you haven't hired people yet. But sometimes your personal runway is important here. So there is a question around, how long does it take to fundraise? And the good news is that 59% of companies were able to complete their fundraise in 12 weeks. And the whole thing takes 15.5 weeks to actually get money in the bank. And then, there's, still, 32% that take 19 plus weeks to complete their fundraise. So some people are going through the slog. Like for my first company, Pursuit, it took me over 6 months to raise, 500K because I just wasn't very good at it. So I don't think that it necessarily needs to take you that long. So I think, 3 months is pretty reasonable or less. And I think a lot of it comes down to your skill as a founder to run the process efficiently. So, take feedback seriously, iterate on your deck. Like your mentality should be, I want to get to know quickly so that I can know what to do with that. I don't want to be in this limbo state of, trying to fundraise for, 6 months. That's not great. And it's distracting, it's demoralizing, and you aren't spending time on your company. So try to get to know quickly. And by the way, you don't lose face if you go out, try to raise a pre-seed round, are unsuccessful. 3 months later, go back to that same list of investors and be like, look at all the progress I've made. They'll be like, awesome, this is great. And maybe it's you've just tweaked how you talk about your product in your deck. It doesn't necessarily need to be that you've hit a hockey stick of growth. Narrative is super important at the pre-seed. So just remember, there's no downside if you have to stop, make more progress, try again in 3 months. People will be happy to chat with you again. So a few key takeaways here from the pitch deck itself. Put in the work. Sometimes people just don't want to, they're like, oh, I don't need to create a deck, or I'll just throw something together, I'm writing code or I'm out selling or something like that. But put in the work on your deck. It is important, and you'll reuse it. You'll reuse it for hiring, you'll reuse it for sales, or at least components of it. And it's not to say that your deck needs to be the most beautiful thing that's ever been created. It's just to say it needs to be clear, concise, and compelling. Number two, have something to show for it. Days of minimum viable PowerPoint appear to be leaving, and unless you're in that 11% camp, and most people are not. And a lot of those people who are able to raise without having a product are usually multi-time founders, or there's no question at all that you're a domain expert and you're very technical. So that's kind of an edge case. And finally, schedule the time wisely. Fundraising is time that takes away from you building your business. So just keep that in mind. Also, it's just not fun to get no's, and almost everyone gets no's in the fundraising process. Even everyone who's on TechCrunch with just raise huge round, those people still got no's, remember? So it's demoralizing, it's time consuming, and no one will care in retrospect how long you spent on it. So be efficient about it. Okay. So this is the second point I wanted to cover, which is around your investor strategy. So this is what should you do around outreach, how many people to contact, how do you set up this process? We just went through what does a successful deck look like, and what does a successful process look like in aggregate. And now we're going to go one level deeper into what strategy you should have to get yourself to success. So a common question I get is, how many investors should I contact? And this one is tricky because it's typically not 3, but it's also not 300. So, the rule of thumb I use is typically if you can have 30 real investor meetings and you get no's from all of them, you probably shouldn't contact another 30, because you should change something. You should make your deck better, different, make more progress on the product, something like that. So what we're looking at here is the number of investors contacted versus the number of investor meetings. So what's important is that there is a correlation between contacting more investors and getting more meetings. So if your initial list is 50 versus 100, you're going to get more meetings if you contact 100 investors. So this is an area where putting in more time will get you more result. However, the goal here is not meetings. The goal is to get funded. And there is not as great a correlation between investors contact and amount raised. So what I read from this is that it's very much a quality versus quantity game, and try to get quality meetings, have real conversations, get real feedback, and get to know quickly, or get a term sheet or get your round raised. So, this should help put some bounds on it around for founders. Like if you know, again, like it's not 300. This is, you know, investors contacted. This is, you know, most of them are under 100. And so that's a tractable list. You've got your Google sheet, you know, you're asking other founders, you're just doing some research, you're reaching out and you're trying to get meetings with these people. And if you get no's from that, like try to interpret what's going on here, and don't necessarily just go for the next batch before making some changes and really introspecting on it. So the investor communication strategy here, you know, average deck length is about 18 pages for pre-seed. So, you know, if you got a 5-page teaser deck, that's probably too short. If you've got some sort of 40-page manifesto, that's probably too long. And, you know, remember the average time across failed and success decks is only 3 minutes and 40 seconds. And so that is a lot of time to absorb information, but it's not going to be reading a ton of text in there. The headlines, the titles need to flow pretty seamlessly with supporting information, because people are flipping through relatively quickly. And a lot of these views happen on mobile phones too. Average number of meetings for a successful pre-seed range is 30, and 58 is the average number of investors contacted. So, you know, you could be fewer, it could be more, quality versus quantity, but this should kind of give you a sense for like when people succeed, how much work did they put in? How long did it take them? And like, what was in that deck, right? So, and for any individual company, these circumstances can vary around what makes sense for you. But we don't see a ton of deviation across startups, at least in like some of this like structural and process side of things. Like the way you pitch your narrative is super different depending on what you do, depending on your strengths as a founder, your history, your market. Like that narrative can be real different across companies, but in terms of process and getting to yes or no, not as much variation. So a few key takeaways for investor strategy. Number one, quality over quantity. You know, you're not trying to meet with every investor on the planet. You want to get intros to people who have already like pre-screened you based on going through your deck, right? There's like, your time is valuable too. You don't want to show up to a meeting and be like, oh, we've got a competitive investment, or oh, I actually don't even invest in your space at all. So you want quality meetings, and you want them to like come to the table with a bunch of questions for you based on their read of your deck. Try for 50 or 60 to investors contacted. That's a pretty safe and average number, right? Like that's still a big list. This is not a small undertaking. This is not like, oh, I'll carve out my Saturday afternoon for this. Like this is going to be weeks of your time. And then choose your VCs wisely. They're with you forever. You know, you're pre-seed investors. So, you know, if all things being equal, pick the people you like, because it's going to be a real long road with them. And just keep that in mind. A lot of founders I talk to are so focused on getting the round raised that they can lose sight of who are the people who are investing. And that's a whole other talk about, you know, what matters there. But just keep that in the back of your head that, you know, if you're starting to get interest, you're probably going to have choice in which investors you take. Choice either like which ones you pick, or choice being like, I'm not going to raise now. I'm going to wait 3 months, make some more progress, and try again. But you do have choice. All right, the final section that we're going to cover here is the odds you are working with. So I will often get questions around, I've been trying for this long, or I'm in this state, like what would you recommend? Is this going to work? Is this not going to work? And, you know, there's never a crystal ball for that, but like we do have some data here on average, you know, how long does it take and what do these things look like? And also based on the makeup of your team, the likelihood of raising, as well as what that raise might look like. And the purpose of this research that we do is because we can't change it, DocSend as a company, but we do want to create a baseline and measure against that. So hopefully over time, just as a startup ecosystem and community, we can help make things more fair, more transparent. And we think the first step is just getting a baseline on what things look like today. So this includes both US and international. US numbers are higher than international typically for the amount raised. So what we're seeing here is all male, about 500,000 for the pre-seed, all female, about 200,000, and mixed gender, the most at 766,000 raised on average for pre-seed. And you can also see here kind of like number of meetings. So, you know, all female teams getting the fewest number of meetings, mixed gender teams getting the most number of meetings. Gender does play a notable role in fundraising, and I don't want to conjecture too much on what's going on here. Again, we're just commenting on the baseline. But in 2019, all female teams raised about 30% less than all male teams. And in 2020, that actually became exacerbated and it was 60% less. Keep in mind though, that mixed gender teams do raise more than either of these categories. So that's at least something. But if you're at the stage where you haven't put your founding team in place, like this can be informative, that having a mixed gender team, either if you're all male or all female, like making it a mixed gender founding team will be helpful for you. And if you're already kind of got your founders in place, I don't think this information should tell you to go back to the drawing board and add a new co-founder or change things around. These are just numbers to be aware of as you go through the process. In terms of where it's taking place, I think this is nothing but a good trend in the sense that pre-seed is taking place less on the West Coast, that primarily being Silicon Valley, LA, Seattle, and you're seeing more founding teams get funded in other parts of the United States. So Northeast has gone up by 23%, the South up by 10%, the Midwest up by 7%. And New York has been taking off as a startup scene for quite a while. And this is just accelerating that. And again, as you see companies exit and go public, that money flows back into the ecosystem, and typically it stays in the geography where it came from, both because the people, the talent, the money is there. And so New York is really growing as an ecosystem. Boston's also great. But then in the South, you see areas like Atlanta, like really taking off, and you see some real notable winners in Atlanta. And so as a founding team, this is helpful because it's no longer the case that you have to move to Silicon Valley. Also look at the rest of the world, up almost 40%. So, I always say that talent is equally distributed, but opportunity is not. And it looks like opportunity is getting a little bit more equally distributed, which is awesome. Also worth noting that if you're in Atlanta, your cost basis as a company and as you hire people, way better than your cost basis in San Francisco. So you can just make money go further. And it also depends on what specialties you need. If you're an AI company and you need like ex-Google machine learning engineers, then you might need to go to Menlo Park or be in the Bay Area. But for a lot of companies, you can start that company anywhere, and investors are increasingly willing to fund those companies independent of geography. So a few other things just on like DocSend and the Startup Index that Cassie mentioned, and within the Startup Index, like the different projects that we have. So we've got one report that, and all of these are reports we refresh on an ongoing basis. One report on the funding divide. So it kind of goes into more detail on discrepancies in fundraising based on gender, geography, ethnicity, that sort of information. Again, baselining it and trying to track it over time. And then we also have reports that are by rounds. So this was the one on pre-seed. And so pre-seed is typically like 500K to $1 million. It's your first round of funding. Some companies skip the pre-seed and go right to the seed. Seed is 2-3 million typically. Seed has different criteria than pre-seed. So go through and read that seed report if you're interested. And if you're wondering, have I made enough progress to skip the pre-seed? Do I need to do the pre-seed? They're very different rounds, and the firms that focus on each are different. They have different amounts of capital under management. They have different criteria. So take a look at that. Series A, again, totally different ball game when it comes to raising. And there tends to be a squeeze at the seed round, and we continue to see that be a case. Like seed is, I think, the hardest to raise. A's look easier. However, there's a big drop off in terms of company death between seed and A, and it becomes more clear if you can or cannot raise a Series A. So there are a lot of companies that get stuck in limbo in between. But if you have the metrics for it, Series A can be faster and easier to get it done, and it's a lot more money. But again, it's different ball games, so take a read through that. And then, last time we looked, the majority of venture capitalists use DocSend for their own fundraising. So if you ever get someone to be like, send me the PDF, it's like, well, VCs all use DocSend too. It's just useful. And so we have a research report on what it looks like for venture capitalists raising their funds. And that's typically smaller earlier funds and like first or second like fund managers. So people a little bit earlier in their fundraising career. And as a founder, if you ever get frustrated fundraising, just remember it's even harder for venture capitalists to raise. It's shockingly hard to put together a $50 million fund and run around and ask family offices and pension funds for money. And it takes a lot longer and you have to contact way more people. So anyway, have some empathy for the VCs, even as you are frustrated going through this, getting no's from some of them. Also, another resource we have, we call it the DocSend Fundraising Network. So if you are a pre-seed or seed stage company, send us your deck. You just email us your pitch deck as a DocSend link. The service is free. We promise to, at a minimum, give you feedback on it, which is something that investors don't do. We've got on the back end a bunch of analysis that we do, as well as a human review, and we'll give you some pointers. And then about 10 to 20% of the decks that we receive, and it's thousands, will cross our quality bar. And then we've got about 80 lead investors, pre-seed and seed, that have all been screened to be like great people to work with, really high quality, like know what they're doing, and we can send your deck to them. And we also know who has which preferences, who does B2B, who does B2C. And so we can kind of save you some of that time to get your deck into the hands of investors that are most likely to lead you around. So give it a try. But again, if you don't make it, don't take it personally. Because it's free, we can't deal with resubmissions, but we'll give you feedback on it. But be sure that it's the final. You get feedback from other people before you submit to the fundraising network, because you do only get one chance with it. But it's been really gratifying to see us get a lot of companies funded, and ones that wouldn't potentially have these intros or get in front of these investors otherwise. And that is it.
Awesome. That was super insightful and really rich. So thank you, Russ. Let's jump into Q&A. We've had some questions come in throughout, so feel free to submit them in the Q&A function in Zoom. We may not get to them all, but let's jump in. So a question around seasonality, especially as it relates to the last year. You know, the summer tended to be dead. Is that still the chance? Is COVID kind of changing things? How have we seen things shift in the last year?
Well, that's a great question. And that is something that we're tracking in real time up on our website under the Startup Index. So we've got a few different indicators there around like how many founders are sending links, how many like decks are VCs reading, what's the average read time. And so in 2016, 17, 18, 19, we did see a pretty consistent seasonality. That seasonality varies a little bit by country, but the US is still most of this, or even countries that are international are raising from US. So that tends to skew the seasonality in that direction. And what that seasonality historically looked like is the year starts off super slow, January and February. Investors are actually active during those months, but founders aren't sending out their deck as much. So the founders that do send out their deck actually get the most visits. So it's actually a great time historically to raise, is January and February. And then you'll kind of see like a peak in like March and April. The summer, everyone says like, oh, the summer is dead. The summer is not dead. It's just kind of flat, but it's well above what you see over the holiday season or the beginning of the year. And so it's kind of like flat throughout the summer. And then there's this kind of like, I kind of call it the oh no rush at the end of the year, like October and November of people raising. And then it really drops off in December. And so that's what we saw kind of historically. So like March is the most likely time. And then also October, November. Last year, everything changed. Everything changed. We were coming into that March peak when the pandemic hit, and it just kind of went sharply down, like pencils down. Everyone's like, what on earth is going on? Investors are taking stock of their portfolio. You see all these memos going around to startups being like, fire everybody, cash is king. And then, some companies did just do very badly if you're in travel or hospitality or some of the areas, but the other areas were all fine. And so then you saw this resurgence last summer in fundraising activity, and we were seeing record numbers of founders that are like new founders raising, existing founders raising, and then VCs like looking at decks and deploying money. So it's just kind of a frenzy, and has been that way pretty consistently since last summer. So, I think the takeaway as a founder is that there's more competition than there's ever been before. The seasonality is a bit out the window. So fundraise whenever is best for you. and really focus on nailing your narrative, the clarity. But there's not really a bad time to fundraise right now. So I think this is awesome. It's like the rising tide lifts most boats, or type of situation. But this is a great time to be creating a company, and you have the option of getting investors to help scale it faster, which is wonderful.
Awesome. Zooming out a little bit, why raise a pre-seed? Does it help with your seed round? Are there some kind of triggers to consider when thinking about pre-seed versus seed?
Yeah, that's a great question. So for DocSend, in our situation, we skipped the pre-seed round. And the reason was that my two co-founders and I are all engineers, and had enough personal runway that we each just put in money and said, let's spend a year on it. And so we were able to build the product. We were able to get people to use the product. And then what we needed money for was not ourselves personally, but to hire other people. And that was the line for us, that we wanted to raise money to hire other people. And $300,000, $400,000, $500,000 isn't really enough to hire a team, which is why we raised 1.7 million for our seed round. But there was some risk in that. Like, I allocated 2 weeks, I set up enough meetings, and I said, if I get to know in 2 weeks, like no one gives me a term sheet, great, we'll pause for 3 or 4 months, try it again. And we got to yes. So, but we could have gone back and raised a pre-seed, but in our situation, we didn't need it. So a lot of times pre-seed is really for personal runway, or for, cost of like building the product. But yeah, if you can skip the pre-seed, that's great. I mean, the other thing I say on, bootstrapping or not is, sure, bootstrapping is great to the point where you can de-risk it. It's all about how much of your personal wealth we want to put in. But typically at a certain point, if what you're doing is working, you're going to want to put more money into the business than you have personally. And that's when you want to take on investors. When you do take on investors, a lot of founders will shy away from having a board. But one argument in favor of getting a pre-seed is you already get a stamp of approval from someone, and you don't usually put a board in place for the pre-seed. But for the seed, you often have the option of or not. But having even quarterly board meetings and board minutes will make your company look way more professional, and future investors or future inquirers will be much more likely to trust you, and less likely to scrutinize like every little thing you've done, right? You would be shocked to hear the stories that investors have told me over the years about founders embezzling, like just not accounting for things. Like there are a lot of things you can mess up as a founder. And as a founder, if you're doing things correctly, it's hard to appreciate why VCs are so paranoid, but they're paranoid for very good reasons. So having a board, looking buttoned up, having a law firm, like these are all things that will help de-risk you in the future, and just make everything easier going forward.
Definitely. Awesome. When we're talking about investors, I know our data is encompassing institutional investors and angels at this round. Do you see any trends or strategies that would differ going after one versus the other at this stage?
Strategies are very different if you are raising what I call a party round, where you're just getting safes or convertible notes together, and you don't have like a lead. So the strategy for doing that, very different than the strategy for getting a lead investor. You don't have to pursue one or the other exclusively, but all things being equal, it is easier and faster as a founder if you can get a pre-seed lead investor. So it used to be the case that pre-seed wasn't even a defined round, and it was almost always like angels that accounted for it, or syndicates like going through AngelList. But about half of pre-seed successful rounds now have a lead investor. And the benefit of that is this is a person who is an investor who's doing this full time. They have raised a fund. They have their own investors called limited partners that have given them money. And because they're doing it full time, they're generally trusted more than a random angel who spent 15 minutes on this and has a job as a CEO like me. And so if you can get that term sheet, then you can fill out the round really fast, because everyone else will trust you. If you're going around and doing the note strategy, you'll typically be doing your close on a rolling basis. So you'll be like, oh, you invest $50,000, you invest $50,000. And the notes don't even need to be the same. So people can do things like tranche it. So one common strategy is to say, okay, the first few angels I'm getting, I'm going to tell them I'm not taking their money, right? Because if I only get 100K committed, that's not really enough to make enough progress. So I'm going to tell them, you know what, I'm not going to take your money unless we get to $300,000, but I need you to use your name to show that I have like momentum. So I'll use those first 3 names to get other people. And then when I get to like that minimum, I'll close it. And then if there's still more interest, I might actually increase the cap on the note for additional people that want to come in later. And then, if you get to that state and you have all that convertible notes and someone gives you a term sheet, you still can take that term sheet. Those convertible notes, though, will convert to equity. Convertible notes have the real great property of not having a closing cost, because they are basically an IOU. You don't have to pay lawyers to go through and actually give them the equity right now. They'll convert it your next round of funding. So just keep that in mind. Like you say, you're raising a pre-seed, you get some people in, and you're like, oh my God, I didn't realize how much demand there was. And then you get a seed investor to write you a check. It is possible that you've raised too much in convertible notes, and that can dissuade a seed investor from getting involved. But that threshold, as long as you're like under $1 million, is typically fine. And what I also see are founders go try to pitch institutionals first. If they can't get any yeses from a lead investor, but they get enough interest from angels, they might like cobble those together and get that round done to make some more progress.
Awesome. That's really great insight. How would valuation come into play, especially pre-revenue? And would you advise or recommend to put that on a slide or get the investors on the phone first?
Oh, this one, I've gone back and forth over the years on the best practice, and I think the market has as well. So there is a scenario where you put down your ask and it's either too low or too high. And that can be problematic for you. So for instance, if you put down, I'm asking for 500K, and then you go pitch Jeff at Uncork, that's too small of an amount of money for Jeff to put in. So you've disqualified yourself. It's possible that Jeff loves what you're doing so much that he's like, no, we're going to give you even more money, but it doesn't look great coming in at 500K. You're kind of negotiating against yourself. The flip side, if you're saying I need 3 million and you're pitching a pre-seed fund, they're gonna be like, that's just too much. And then they're gonna feel like if they offer you a typical pre-seed, valuation and amount, you're gonna feel, slighted by that, or they're gonna, make you angry at them, and they don't want to be in the business of annoying or frustrating or insulting people. So you'll probably DQ yourself there too. If you do get feedback, so like one good way to do this is go to any investor that's around later, or go to another founder and be like, here's what I've got. Do you think I'm pre-seed or seed? Get a few people to comment on that. And then once you get a sense for like what bucket you're in, there are just kind of market numbers for that. And that's in the pre-seed and the seed report. Like we have some of those numbers in there. And some founders really stress about optimizing for how much dilution they get or how much they're raising. But the more standard you can make your ask, the more likely you're going to get your round done quickly and just get back to building your company. And the way to save on equity as a founder isn't to only give up 5% in your pre-seed versus 10. It's to skip the seed and raise an A. Like you save equity by being capital efficient. And you lose equity by having to do a bridge round or a down round. That's where founders get wiped out, is like they raise a seed, they like can't really get to A, so they have to do another like flat or down round there, and that's really hard to recover from, and it's hard to stay motivated for you and your team. So you do, as you raise, want to be thoughtful about how you use that money and what your next milestones are. But yeah, just focus on getting the deal done, and there are market terms for the amount of dilution you're getting, the employee option pool that you're getting, and then the amount that you can ask for. And that also differs by geography some.
Alrighty. We did have some questions come in around how some of these trends vary based on hardware and SaaS companies. I don't think we dug into that in our research, but I was curious if you had some overall kind of insight or feedback that you've seen just from being pitched one versus the other.
Yeah. So if you're going to go start SpaceX, you kind of need to be Elon. It's kind of hard for that to be your first company. We have had some very notable hardware companies like GoRaise and DocSend that I've talked to over the years. Even some of the synthetic food companies that have gone through and raised a ton of money, it is just harder. The more capital intensive your company, the harder it is to raise. And the way you overcome that is just by being personally really impressive. That's like hard to change. You kind of are where you are in your career. So it might be the case that you need to get more experience. You need to go work in that industry more. You need to go work at a big company. You need to go find a co-founder that can, has that pedigree or something. Like you have the insight and the technical ability, and you need someone else who's got the pedigree to help you get there. So it is harder. One of the reasons it's easy to raise, well, easier comparatively to raise for like a B2B SaaS company, is that the margins are incredibly high. Like the cost of running it is pretty low. And they're typically like really profitable. So it could be huge. It could scale incredibly quickly. It also could just be in the middle and it could be fine. So those are just really positive characteristics. And so as you get into business models that have less ideal characteristics, investors are smart. They get that. And so that counts against you. I wouldn't let that dissuade you from starting your company though. If you have an insight and you're like, this is going to be huge. Also keep in mind that we're talking about things that can be venture scale. There are tons of great businesses that should be started. Not all of them should get venture capital investment or even investment at all, or different types of investors. And so we're talking about companies that have the potential to be like worth billions of dollars. So you got to keep that in mind when you're putting together your pitch as well. But if you've got a hardware insight that could be billions of dollars, like, go for it. Just know it might be a slightly harder road for that. And the way that informs your process, the way that informs who you talk to will be different. I would urge you to go talk to other founders who are in the space, who have gotten through it successfully. And also don't waste your time on investors that are just categorically opposed to what you're doing. It's a waste of your time. And some investors are open to it and some just aren't. And that is often informed by their own investment history. Like they got burned a few times in the space and they're just kind of done with it. So you're not going to overcome that muscle memory and that long memory for them.
All right, I think this will be our last question, and it's a good one to end on. So sorry if we didn't get to your questions. We'll send the recording out, as mentioned, the slides, the report, everything that you guys have seen today. So how do you know if they are going to be a good investor?
That was the question. How do you know
Yep.
maybe a good investor? Well, it's short, it's to the point. References are really important. And a good investor will be very forthcoming with references. So our investors, when they become interested, they'll say, talk to anybody I've ever invested in, even the ones that are unsuccessful. And you as a founder want to go talk to a couple of their investments that failed. Ask them, how did that investor react? At what point did that investor know that things weren't going according to plan? Did they try to fire you? Like, how open were with you about like options? Did they use their pro rata if you were able to get a new term sheet? Did they let you sell? Like, how helpful were they? So references are really important. And reputation is like relatively well known. There is kind of like a tier one of investor, like Charles at Precursors, very well known in the industry, great investor, wonderful person. Like, and you can see that just by going to investor's website and like seeing their track record. Go to their LinkedIn. How many years have they been in this? And so someone who just some of like the worst things I've heard about investors are if they're from a not Silicon Valley background. Like, things do work differently in other parts of the world around like terms that are in there, like participating preferred or liquidation preferences, or there are some things that happened in like private equity land that are like really not like founder or company friendly. And so people who are trying to put those terms in there, that's a great indicator that maybe you're not on the same page with them. And so you want to educate yourself a little bit on the terms and what is market. And if you have a law firm that is, kind of steeped in Silicon Valley or startup, that law firm will be able to give you some good advice on if these are market terms or not. So, don't get the random lawyer who has no experience in this world. They will not know what market is, and they will not be able to give you good advice on, like what to look out for as a leading indicator. And I think that kind of goes for service providers in general. Like you want people who have played this game before. We got an accountant for DocSend when we started, and it was the wrong accountant. And this person one day was just like, Russ, did you know you're just losing money? I'm like, yeah, we're a startup. That's our job. We're just losing money. I was like, oh my God, this person has no idea how startups work. So we got rid of that accountant, got another accounting firm. We worked with them for a few months, and then they sat down with me like, Russ, did you realize you're not losing money fast enough? And I was like, this is the accountant I want who understands how this game is played. And the same thing goes for angels. If you get some angels that are committed, that have experience in your industry, they can also help inform you who are good lead investors and who might be most helpful to you.
Awesome. That's great. That's a funny bit about the accountant. All right. Well, thank you guys so much. Apologies if we didn't get to your questions, but we will be covering this data more and more over the coming weeks. So we will have a Clubhouse session actually in 2 weeks. So look out on Twitter for that invite if you want to come join Russ and talk even deeper and live online. So thanks guys so much. Thank you, Russ.
Thanks, Cassie. Thanks everyone for joining.